Hi, everyone. Marty Becker here with our first case study of the Atlas Annuity Strategy. Let's dive into this and let me introduce you to Mike and Stacy. Now, just a quick disclosure that this video is for educational purposes only, and it is not intended to be interpreted as any type of tax advice or a recommendation to buy or sell any securities product. So, this is Mike and Stacy, wonderful couple. At the time we met, they were 67 and 64 years old. Now, Mike is already retired and Stacy is going to work for 2 more years. Their only income will be Social Security at approximately a little under $48,000 per year, assuming a 2% COLA. They currently have about $500,000 in their IRA, and it is currently invested in a 60-40 portfolio with a 1.5% management fee. Now, when Stacy retires, they're going to need approximately $72,000 per year. What that does is it leaves an income gap of a little over $24,000 between their Social Security and what they actually need. Now, going back to that 4% rule, that states they should really only take about $20,000 from the IRA, starting in that first year that Stacy retires. The reason we can only use 65% of their $500,000 is there's something called suitability in the annuity industry. The annuity companies will not allow you to put all of your investable assets in the annuity because even they understand that life happens, and at some point you're going to need some money outside of the annuity for emergencies and other investment opportunities. Now, there are some exceptions to that rule, but a good rule of thumb is basically just around 65% as a max amount of your investable assets should be used towards an annuity. So, how do we fill the gap with only $325,000, which now makes it over a 7.4% withdrawal rate? So, what can they do? Basically, they have 3 options. They can keep doing what they're doing, they could take more risk, or they could spend less money. Now, if we assume a 7% return in their equities and a 3% return in their fixed investments, and they just keep doing what they're doing with a 60-40 portfolio, in a perfect world, they would be totally fine and they would still have about $200,000 left when Stacy turns 100. However, we do not live in a perfect world, and this is not how returns work. But this is how most advisors present retirement plans. Everything is based on averages, but averages are useless in retirement planning. The market and bond coupons and treasury rates are going to go up and down throughout the course of their lives, so we cannot count on this level scenario. What we really need to do is have a look at what would be our worst case scenario. If Stacy retires in 2 years and the market starts to crash in a negative sequence of return scenario, like what happened in the year 2000, they will run out of money in their late 80s or early 90s. So logic tells us that if they were to take more market risk, a bad market will yield the exact same results of running out of money, only they're going to run out faster. So chasing interest rates with more risk is not the answer either. So there's one last option, which would be just to stick with the 4% rule and spend less money. And if they did that, even in a worst case scenario, they would be totally fine. Their money would last them all the way to age 100. But that doesn't give them what they want or what they actually need for income. So how do we get them more income with only using a portion of the portfolio? Well, we looked at using a couple of income annuities. The income annuities can give them more spendable income on a guaranteed basis because income annuities use mortality credits that are based on age and not on market returns. So with their customized strategy, what we did was fund two separate annuities. The first one, we funded with $250,000, and we exercised a 10% penalty-free withdrawal as soon as Stacy retires. This annuity is unique in that it has the opportunity to grow and increase the income on a non-guaranteed basis until Mike turns 95. But even when we use a very modest projection of 3.5% growth, we would have taken a little over $24,000 per year. And then at the end of the 10th year, we will kick on the internal income rider, which should provide approximately $11,300 per year. Obviously, that's not going to be enough. But remember, we have that second annuity that has been deferred this whole time, and then we will turn on the income at the same time the first annuity reaches the end of the 10th year, and then the second annuity will provide a guaranteed amount of $12,880 per year, so almost $13,000 per year. The other thing they could consider doing is getting more aggressive with the rest of their portfolio. Now, you may be saying, Marty, you just said a couple slides ago that more risk wasn't the answer. In fact, it could hurt them. However, now that they have the majority of their income needs covered, they can ride the ups and downs of the market. And the market is where they're going to get the bigger gains. And the market is also the best long-term solution to inflation. And as time goes on, all of the additional taxes they will need, plus their inflation offset, will be taken from the remaining portfolio. So let's see how this thing turned out. What we can do is actually compare the two plans side by side, and we can compare them in a worst case scenario and a best case scenario. Now, the red line represents what they are currently doing with their 60-40 portfolio, and we already talked about how in a negative sequence of returns scenario, they would run out of money. The green line shows what would happen in a worst case scenario if we insert the annuities into the plan and then reallocate the rest of the portfolio to that 90-10 like we were talking about. And as you can see, in the early years, their net worth is basically neck and neck. And then it starts to pull away from the red line, again, which is what they're doing now, the 60-40 portfolio, and they have plenty of money even until age 100. And let's also ask the question, how would Stacy feel down the road when Mike passes away at any point in the future? Because when he goes, she is going to lose one of the Social Security incomes. So do you think she's going to feel better knowing that the annuity income is going to keep coming in no matter what without having to do anything? And she still has the portfolio with several $100,000 in it, even in a worst case scenario. That's an important point that most people don't think about because they don't want to think about their own funeral. And I get it, but it's going to happen to every one of us, and we have to consider it and be prepared as much as possible for it. The other criteria that we want to look at is the reliability of income. I tell all of my clients, in retirement, ROI no longer stands for return on investment. It needs to stand for reliability of income, meaning how much of their income needs are covered on a guaranteed basis by things like Social Security, defined benefit pensions, income annuities. With the current plan, only 80% of their needs are covered, which is why the portfolio starts to get depleted over time. But with the Atlas Annuity Strategy, 100% of the income is covered, which is why the portfolio continues to grow because they are relying on it for very little at that point in the future, basically just for inflation. I can't be a hypocrite, and we need to look and see if there would be any opportunity cost by using the annuities. And at the end of the day, there could be. Because if we go into a positive sequence of returns, like going back to 1995 in the S&P, where the market had 5 huge years in a row, and it just starts going up and up, well, then they could have more money in their portfolio. But for Mike and Stacy and a lot of my clients, the best worst case scenario was more important to them than the best case scenario. They don't want to worry about the market anymore. They just want to know that they're not going to run out of money, but also still have some opportunity if it presents itself. This is what they considered their sleep insurance. Everyone is familiar with life insurance that protects you and your family if you die earlier than expected. Income annuities are insurance that protects you and your family in case you live longer than expected. So this idea of sleep insurance is personal for me too, because as a firefighter, knowing I had a pension gave me peace of mind. I didn't have to worry about the future. But when my pension disappeared, I wanted to create that same kind of security for my own family, and now I can do it for my clients as well. Now, one of the other indicators we look at to determine the health of an overall retirement strategy is something called discretionary liquid assets. What this concept really addresses is one of the fears most people have about annuities, or they are told they should have about annuities by their current advisors who don't understand annuities at all, is that the fear is the annuity is going to lock up your money. What they don't understand, however, is that if the purpose of the money is to generate income, that money must stay invested to continue to generate that income. Here's Dr. Wade Pfau again in an article he wrote addressing this very subject. Here's what he says. In a sense, an investment portfolio is a liquid asset, but some of its liquidity may be only an illusion. Assets must be matched to liabilities. Some, or even all, of the investment portfolio may be earmarked to meet future lifestyle spending goals. Retirees are free to reallocate their assets in any way they wish, but the assets are not truly liquid because they must be preserved to meet the spending goal. Assets cannot be double counted. And while a retiree could decide to use these assets for another purpose, doing so would jeopardize the ability to meet future spending. Basically, what he's saying is that just because you have $1 million doesn't mean you can go in there and grab $100,000 and buy a boat, because all that money must stay invested to continue to produce the income you need. Yes, you have it, but in reality, if you don't want to screw up your income plan, you only have it on paper because it cannot serve two separate functions at the same time of producing income and having discretionary mad money to spend in lump sums. It's either one or the other. Let's go back to the graphs and look at how much of their money is actually tied up in the two different strategies. And remember, the red line is doing what they're currently doing, and the green line is the Atlas Annuity Strategy. If they keep doing what they're doing, after a couple years of retirement, their discretionary liquid assets drop to zero, meaning they cannot tap into any of their portfolio without an ever-increasing risk of running out of money even earlier than we talked about before, which again was in their late 80s, early 90s. With the annuities being implemented in the plan, you can see they always have at least a couple $100,000 that they can tap into if they so choose. And what does that really mean for them? Maybe that is buying the boat, or taking their grandkids on vacation, or giving their kids a down payment for a house. What that green line represents is options for their lifestyle that they wouldn't have with their traditional retirement plan using a 60-40 portfolio. And this is the worst case scenario, because if we look at the best case scenario where the market takes off early in their retirement, their current plan doesn't leave them any discretionary funds after about 15 years or so. So if you recall from the earlier slide when we were comparing net worth between the two plans, their current plan had a higher net worth in that positive scenario. Well, that's great on paper, but what good is net worth if you can't use it? Okay, we're going to be wrapping this up soon, but stick around for video number 3, where we'll go through another Atlas Annuity Strategy case study. And just to state what may not be completely obvious, the math in this particular case study works regardless if you have $500,000 saved for retirement or $5 million. No hype, no opinions, just verifiable math. Okay, so in the interest of wrapping up this video, I want to show you a true apples to apples comparison. Meaning, if Mike and Stacy were to take the same $325,000 and put it into a managed portfolio with a 1.5% management fee, what type of return would they have to get to ensure the portfolio would provide the same amount of income and never run out, even if they live until age 100? They would have to earn 8.5% interest every single year with no losses ever. And that just ain't going to happen. And you may say, Marty, okay, I don't want to plan until age 100. And that's totally fine. But you think we should plan until at least age 90? That's a good idea. But even if they only need the money to last until age 90, they would still need a 7.5% return every single year with no losses ever. And again, that's just not going to happen. Only the annuities, because they're based on age and mortality credits, can provide that high of an income forever on a guaranteed basis. Okay, everyone, so just a quick wrap up of what we did for Mike and Stacy using their Atlas Annuity Strategy. Again, they're 67 and 64 years old with $500,000 in their portfolio. They need a little over $24,000 in additional income, which puts them above the 4% withdrawal rate. They're looking for safety and guaranteed income while also having opportunity for growth. We knew we could only stick with about 65% of their portfolio to get them the income they needed using the annuities. Total starting withdrawal from their portfolio really should only be about $20,000 per the 4% rule. But with the Atlas Annuity Strategy, we were able to get them the $24,237 they needed to fill the income gap, which works out to be over 21% more spendable income in the first year. Now, if you're looking for a no-nonsense retirement strategy without opinions or speculation, then the Atlas Annuity Strategy, maybe you've worked hard your entire life to save this money, and now it's time to make it work for you and to give you what you want and what you need in your retirement. So what you can do is book a time to talk with me by going to atlasannuity.com to get your questions answered and to see how the Atlas Annuity Strategy can help you maximize your income and protect your future. So I want to thank you for joining me in this case study using the Atlas Annuity Strategy. And again, stick around for video 3 for another interesting case study.